Good morning, everybody. Welcome to our session. Always good to see all of you. There's a lot to talk about today. There's a lot happening in our world. We can't talk about all of it, but we're certainly going to talk about some of it. What we've got lined up for you for today is there's been a lot of noise in the media around the structural demise of the dollar. So Ian has done some research on this topic for us, and he'll be sharing his insights with us. Continuing with the unpacking of the different sections of our investment funds toolbox, the seed shortlist, Tawanda will share insights around the multi-asset high equity or the balanced fund section as it's more widely known. And then lastly, Mike will give us an update on the seed balance fund as one of the building blocks on the seed shortlist. Just a little quote to position our day. In an economy where the only certainty is uncertainty, the one sure source of lasting competitive advantage is knowledge. So that's certainly what we try and give you in these sessions. So as always, you're welcome to ask questions. You can put up your hand at any time or just type it in the comments section. But if I can just ask that you keep yourself muted otherwise. And then on that note, Ian, I'm going to hand over to you to kick us off with the dollar discussion.
Great, man. Thanks, Adrian. Morning, everyone. Good to be with you again. Okay, so the dollar is the topic. It's always a fascinating topic. I find it very fascinating. Been looking at it for many, many years. So put some high-level notes about this, and it's all about the perspective. I mean, this is not a new thing in terms of so many people calling for the demise of the dollar. It's been going for, in my opinion, for at least 20 years. But it comes and goes. There's no question that increasingly more and more countries and their respective currencies, or potentially blocks of currencies, are looking to potentially rival the dollar. So that is a given. But I don't think that you must think that the US dollar is going to collapse in a heap very soon. Will the dollar eventually fail? It will eventually fail, and I've got a chart on that as well. All fiat currencies ultimately collapse, but just don't bet against it too soon. So when we look at the dollar, we look at a number of things, but this is the index, its index against its trading basket of currencies. And yes, it goes through ups and downs, but it's effectively at the same level as it was 50 years ago. Had some very prominent peaks, and we'll look at that as well. 85, 2000, and a peak now. But essentially, it's moved in this big, broad sideways band relative to other currencies. Conversely, if we look at the rand, this is the rand versus the dollar. It's depreciated over the last 45 years, where it did trade, closer to parity by a substantial amount. It's not a one-way bet. It goes to these massive depreciation levels, and then tends to come back again, surprisingly. But the trend is negative. We must always remember that this is just the index, i.e., it's just one currency versus another. It's not taking into account the assets that underlie that currency. It's not taking into account the interest rate. If you put your money into the dollars, or if you put your money into a bank in rands, yes, you've got a higher interest rate to compensate for that differential of inflation and the structural differentials. So yes, it's depreciated massively, but over time you have got a degree of compensation for the additional interest rate differentials. I mean, it is interesting to note just that on an index level, in 1980, 1,000 rand would buy you 1,200, and it's depreciated down to $278 and down to 52. Okay, so that's the currency. That's our currency, the rand. But today we're just trying to spend a bit of time looking at the dollar itself. So this is again back to the index, the dollar index, and the information that we get from BCA is when they look at it from a purchasing power parity perspective, And there's some metrics, a bunch of metrics that go into that, which is effectively that green line there, effectively the dollar's fair value versus a trade-weighted basket. Yes, it does appear to be on the expensive side. And there's a number of reasons why, for periods of time, currencies are expensive and currencies are cheap. But you can see there those peaks that are mentioned. 85 was the big one, 2000, and then we've had this peak again. So there's a degree of merit in the fact that you've got the dollar looking to depreciate relative to a basket. If we look at the reserves that different countries hold as their foreign exchange reserves, there's been a lot of talk about the fact that the dollar has obviously reduced, and that is a factual statement as well. From levels of 80%, 70%, it's come down to slightly less than 60% of reserves held. So, countries need to hold reserves in a basket of currencies to ultimately pay for their imports. But it's interesting that there's no one else that's really close to being dominant. The euro was, in many ways, I think it's been a little bit of a disappointment that they couldn't get the euro to properly compete with the dollar. And then you can see the Chinese renminbi, it's just less than 3% of reserves. I mean, that's the big one that really wants to try and compete, but it's still a long way off. And we'll look at that as well. So if we look at a little bit of history of global currencies, it ultimately all starts with powerful countries and how they enforce the rules as to how trade will work. Over time, though, nothing is permanent, and you have the rise and then the demise of countries. So nothing lasts forever. Pre-94, and we'll look at 94 as why 1994. But essentially, you had precious metals, mostly silver and gold, that were considered as the base money. On top of this, credit and currency has been added. And effectively, over time, it's got more and more fractionalized, i.e. more and more paper money issued by banks and governments on top of base money, gold. And, over time, you've had different reserve currencies. Reserve currency essentially just is paper money that can be used outside of a country's own borders, effectively, that can be accepted. And, you had, before the US, you had the British Empire, and before that, the Dutch Empire. And I've got a chart here on the next one of just histories of reserve currencies. Now, it's maybe more sort of history of sort of the dominant players, as it were, over time. So, this goes back 500 years. You had Portugal, Spain. You had the rise of the Dutch. Especially, obviously, as effectively as they took territory around the world, and that's essentially what makes these strong and dominant countries. You had the rise of the Napoleonic France, and then UK. Europe didn't really get anywhere after those countries, and then we're back to where we are here. The United States. It is interesting that this particular thing, detail has sort of mapped out the years of dominance. It's typically, call it 80 to 110, 120 years, whatever the number is, as a sort of indication. And so here we are, about 100 years from 1920, but it's probably been slightly less than that. So if we go back and look at why 1944, well, that's when we had, post the two world wars, and obviously post the Second World War, Europe was pretty much decimated and substantially weakened. The US was relatively unharmed. And so the US arranged this sort of monetary conference at Bretton Woods Hotel. I've got a picture on the next page. We'll look at that. And they were effectively saying, listen, guys, this is how it's going to work. This is the way the currency system is going to work. and they could dictate ultimately. So what they did is they agreed and said, okay, this is, and there was a pretty substantial conference with a lot of people, and I'm not sure how long it took, but at least a week, maybe longer. Essentially what they said is, okay, we're going to peg the dollar to $35 per ounce of gold, and all other currencies would effectively be pegged to the dollar, with a little bit of potential play. Essentially, the idea was to promote global stability, but the US was essentially taking the lead. And that put the dollar firmly in its place as the reserve currency, and ultimately officially sort of took over from the British pound, which was devalued. So here's a picture of the hotel that they met at in 1944, Washington Hotel in Bretton Woods, New Hampshire, the US. Pretty decent looking place. So that system worked very well generally up until the 60s, late 60s, and then into the early 70s. And there were problems that were starting to creep in. The biggest problem was that deficits, and US was running massive deficits, and inflation, especially with the Vietnam War. So essentially what happened is that the currencies were receiving dollars, and they said, listen, we actually don't want this piece of paper. We want the gold. And particularly the French, they were not happy with the system which they called America's exorbitant privilege. And so increasingly so, the countries were demanding more and more gold. So it got to the point where the US was essentially forced, forced in inverted commas, to end the system, the convertibility of dollars to gold, and effectively ended the Bretton Woods system. America was losing gold. Gold was physically moving out of its Fort Knox as money was converted. It was known as the Nixon shock. It came through on a Sunday evening, 15th of August, 1971. And initially it was meant to be temporary. Oh. Sorry, am I back?
Yeah. We lost you for a sec, but you're back here.
Yeah. All right, good. So it was initially meant to be temporary, but it's permanent. Ultimately, at that point, all currencies were essentially devalued against hard assets, gold and other assets. And from that point on, we're essentially free-floating, effectively fiat. Fiat means by absolute decree. And it's basically saying there's nothing of intrinsic value to this piece of paper or metal coin or even a digital. It's got no intrinsic value, but it's got value because the government declares that it's got value. And oh, by the way, you need to pay your taxes using these tokens. And so that's what we have now. Post that, though, the dollar didn't just fall into a heap, even though they'd ended the convertibility of dollars to gold. I think the big factor was the petrodollar system. America said to Saudi Arabia and to a range of other countries, you guys need to price your oil in gold. We'll provide protection. And so by pricing trade, and especially a commodity such as oil and gold, oil in dollars, it effectively required all currencies to hold dollars to buy the required oil. The dollar then essentially got more and more and traded as a network effect. You have this network effect. All countries need dollars in order to affect trade. And so you've also got global debt, a huge amount of global debt denominated in dollars. And that's even countries such as South Africa. We always talk about the fact that we don't have too much, but we've got dollar-denominated debt, which means we need dollars to pay for those, to pay for that debt. And every single country's got dollar-denominated debt. You've got other factors which prop up the token, i.e. the US dollar, and that's the demand for US assets from outside. You've got other factors like strong property rights. You've got capital markets, bond and equity. You've also got what I think is underestimated in so many ways is the US economy and its resilience. It's largely self-reliant. It's not reliant on exports like so many other countries, including China. And clearly you've got it as still the world's strongest military force. Other factors which are maybe also underappreciated is the ability and willingness of the US to provide ongoing currency swaps. So, while they've got the dollar as the dominant reserve currency, they also recognize that sometimes other people are short that particular token, and so they provide these sort of currency swaps. It all adds up to sort of entrench the dollar as the currency that's needed. And then the other factor, which is quite interesting, is obviously we've got this polarization that's happening. Clearly, there's a lot of discussion about even the likes of the BRICS trying to create something. But what you don't necessarily appreciate is the fact that on the other side of the discussion is the fact that up to 44 countries who are siding more and more with the West. We obviously don't know where South Africa sits in this, or maybe we do know. Is actually siding with the US, and actually, in many ways, that's going to entrench this sort of network effect for those particular countries. Obviously, at the edges, there is some fraying, but I don't think, again, that you want to overestimate that at this point in time. If we compare to, say, China, which is obviously the big other dominant country that really wants to do away or bypass the dollar, it's a huge economy, but it is reliant on exports. It does not yet and is not yet a global dominant military power. It does have these capital controls. It does have shallow capital markets, and that's a big one. Capital controls and shallow capital markets, that's going to take a long time to really get to a point where you've got proper convertibility in and out of the Chinese renminbi. It's coming off extremely low base, and it doesn't have that network effect. But yes, it is trying different things, including digital currencies, and obviously siding with a lot of other countries, including even Saudi Arabia and oil producers, to price commodities into different currencies, into its currency. But still a long way to go, in my opinion. All right, so just some concluding thoughts. Yeah, the dollar is slightly overvalued, and we're looking at that again from its purchasing power parity basis, not looking at it relative to the rand. In general, it is slightly overvalued, but there's a lot of factors. Sorry, did I go off again? We're back, Eddie.
We lost you for a sec, Ian. You're back.
Yeah. Sorry, man. So there's a lot of factors that lead to this demand versus supply, and so you can understand how it can be slightly overvalued. The dollar gives buying power to the US, but at the same time, the negative effect is it has undermined the industrial base of the US, and that's a problem. It also gives the US this cheaper borrowing costs, so that's a positive. But the negative is led to high debt levels, and that's a negative. You've got other positives, such as the fact that companies don't have currency risk, and the government doesn't have that currency risk. It borrows all in dollars, and it can keep on printing the dollars to pay. So it doesn't have exchange rate risk. You've got the really the entrenched network effect, and that's the difficult thing that everyone else has to try and undermine, is that entrenched network effect that the dollar does have. And also, I think, if we take a step back, a weaker dollar is not necessarily a net negative for US or global assets. So again, as investors, we mustn't get too hung up on the currency per se. And I've concluded with this particular thing because I think this is so important. The currency is just how can I say, it's the counterpart to what you ultimately own. And unless you actually physically own dollars, which are just sitting in your wallet or maybe in your mattress earning nothing, maybe then you need to be concerned. And you should be concerned, because over time, that piece of paper, where it's a dollar or a rand, has and will continue to depreciate against any real asset. And here I've just put against gold. Gold as a base commodity, as a base currency, as a physical currency. Your paper assets have depreciated against it and will continue to be the case. So the dollar has depreciated 8% per annum against gold. And in rand terms, if you just had a piece of paper, it's depreciated 15% per annum. That's another way of saying gold has gone up 8% in dollar terms per annum since 1971, and gold has gone up 15% per annum. But another way of looking at it is that actually your piece of paper relative to your asset has depreciated by that. And that will continue. There's no question about that. So yeah, those are some concluding thoughts on the issue of the gold. 20 minutes. That's it, Adrian. And
Thank you, Ian.
maybe you guys might have some questions we can chat. Thanks, guys.
Thank you, Ian. Is there any questions for Ian at this point? Maybe an interesting number to just add to this that Tawanda shared with us from his research. So, and just shows the power of interest rates. So if you invested $100 on 31 December 1990 into a US bank, so you didn't keep it under your mattress, and you invested $100 in a South African bank earning South African dollars today, and your $100 in a South African bank will be worth $181 today. So you would actually have been better off earning South African interest on your rands than you would have been earning dollar interest on your dollar. So just got to look at the investment opportunities in context and not just at the exchange rate. And I guess that's sometimes where the difficulty comes in our discussions with our clients around, do you go offshore and by how much and for what exchange rate? But thank you, Ian. Those are very good insights. Iman, we're going to hand over to you to take us through the multi-asset high equity section. Sorry, there's one question that's popped up there from Wade. He's asking, is gold the ultimate investment to place your savings in? Ian, are you there?
You're muted, Ian.
There we go. Sorry, gold. I mean, we do like gold as a component. It's not the be all and end all. It has gone through long periods of time when it just hasn't done its thing. But increasingly so. It is interesting how many central banks are loading up on gold as a reserve asset. So I think with all investments, nothing is necessarily binary. Gold has got a lot of deficiencies because it doesn't pay you an interest rate, so it just sits there as a lump of metal. I mean, ultimately, that's what it is. And yes, it has gone up, but it's only gone up because, as I said there, currency in and by itself has depreciated. What happens with gold is that in times with higher interest rates, it struggles, and with lower interest rates and lower real interest rates, it'll do better. So, all things being equal, if interest rates start to come down, and especially real interest rates, gold in theory should push ahead a bit more. But yeah, we don't put everything into one asset.
Thanks, Ian. Wait, I hope that answered your questions. There's one question there from Dylan. He says, may you please explain further what's meant by shallow capital markets in China and how long you would estimate it would take for China to develop more sophisticated capital markets?
I think the shallow capital markets is the fact that, it doesn't have a huge, let's say, debt market that the US has. So the bond market, people can't easily just buy and trade and move in and out. I mean, I saw a story even this morning again of investors selling some of the debt. So there's not, the US talks in terms of trillions of dollars, in terms of trillions of debt. So at the same time, while the debt is a problem for the US, at face value, it might appear to be a problem. On the other side, surplus reserves can sit there and easily buy the US debt and move in and out It's not the case with China. It just doesn't. It just hasn't got to that point. It's a long way from that point. And so money can't just move in and out of China. You've got capital controls, you've got all sorts of issues. So it's a lot more of a closed environment. You can always take it as South Africa in a way. It's only multiples of South Africa, but investors are not trading in and out of Chinese debt and financial markets. So the two almost can't be compared, Chinese capital markets and the US capital markets.
Thank you, Ian. Guys, let's start with T-Man. In the interest of time, we can always take more questions at the end. Thanks, Tawanda.
Thanks, Adrian, and good morning, guys. Great to be with you again. We're going to go through the high equity section, which is quite a popular section of the shortlist. And this is more on that high growth level for an investor. So an investor who's looking to create wealth and just looking to outperform inflation by at least 5 or greater percent. So longer term investments greater than 5 years at a minimum that we're looking at there, just for greater growth that you get from that high equity. As a start, as we always do, just to give you a feel of how we look at the shortlist matrix. So that top section there that you've got, you're reading the shortlist matrix from the top to bottom. That top section there is got the list of the funds that we've got that are shortlisted, and below that we've got some blends that we recommend for you. So we give you different funds with different characteristics, and we try and blend those funds together to get a more optimal solution for investors over time. So we'll kick off. We've separated this shortlist or this section into a section for the multi-manager funds, a section for the large manager funds, a section for boutique funds, and low-cost solutions. That was just the thinking behind the shortlist, to give you different options with different characteristics. So just to kick off with the multi-managed solution, so this is the seed fund, this being that a seed balanced fund managed by Ian and Mike. And the key thing there with the approach there is you've got diversity of managers, so you've got different underlying managers that fall within that strategy. And what Seed is trying to do there is to do strategic and tactical asset allocation. So looking at asset allocations between the different asset classes, looking at where the best opportunities are, and then obviously allocating to the different managers who have expertise in those specific asset classes. So that fund is decently sized at over at around 1.3 billion and has a greater than 10-year track record, as we can see. So if you just go to the next page, that just gives you a quick summary on the right-hand side of the performance over time. The short-term performance relative to the peers, looking at those quartile rankings, has been fairly decent in that short to medium term. If we look up to 3 years, like I said, the fund has over a 10-year history, so also quite decent performance over those 10 years. But as we have discussed previously, it did go through a difficult period during that COVID 2020 period, with it had higher allocation to growth assets, particularly on the property side. So, I mean, as you can see, on a year-to-date and one-year basis, pretty much top and second quarter, but baked into those 5-year numbers is that higher allocation to property, which obviously detracted from performance. And just on the left-hand side, what we mean by it's multi-managed is that we've got various fund managers and fund strategies there. So I've just listed a few examples on the local and global side of some of the managers that we've got. And so on the local side, you've got the likes of a Fairtree, Abax, Visio, Prescient, and Taquanta managing that Negro Bond Fund. And on the offshore side, showing that preference that we have for quality fund managers. You've got your Fundsmith and Linzo Train. We've also got low-cost providers there, as shown by the BlackRock. Those are the iShares ETFs, and then also on the growth side, just to blend the different equity styles that we've got on those. We've got Bailey Gifford, which is a global growth, which is quite a good global growth manager. So if we move on from the, Mike will take you through additional detail on that seed balance later on. If we go through the section for the large managers, here we've got Alan Gray, Coronation, and 91. And I mean, if you look at the inception dates at the bottom there, these funds have been there since the 1990s and have been quite good performers over a long period of time. So and if you look at the assets, this is why we call them the large managers, quite huge funds there. Alan Gray, 177 billion in assets, the smallest fund being that 91 managed fund with 31 billion. So quite huge funds that you've got there. If we look at the approaches that these funds use, then they pretty much doing research, which is what we call on the individual shares, which is what we call that bottom-up fundamental research. So doing detailed analysis on shares and fixed income instruments to actually get to understand them. But then when you look at that equity style, there are some slight differences that come into the way that these managers look at shares, or have differences in their in the way that they look at investments. And these slight differences is what results in different performance characteristics that you get that you get there. So as an example, your Alan Gray, they've got a contrarian valuation approach, which means that they tend to be different from the rest of the market. So as you may have seen in the recent past, then Alan Gray is outperforming everyone because their portfolios have been positioned quite differently from other guys. But because of that, they can tend to go through cycles where they're either outperforming or underperforming because of that contrarian, which just means they're very different. They all tend to use valuation. So similarly, Coronation looks at the valuation, which is important in their process when looking at shares. What's also quite different is when we've got the 91 managed there. This manager is very flexible in their asset allocation decisions. So very active, not afraid to make big changes to the portfolio. So this is the one reason why we've included the 91 managed, because if they're not happy with what's in the market, then they can have a very big cash position in that. So very active on the asset allocation side. And when you're looking at the equity style, then they're looking at earnings revision, which pretty much just means if shares, or if a company's earnings are being revised upwards, then that looks more attractive for them, then they'll be buying those shares. And if the earnings are being revised downwards, then they would be selling those shares and not holding them. And then lastly, they've just got the 91 opportunity fund, which is a quality bias. So looking for the what you call the best companies out there that have low debt and high returns on equities. So if we move on to the next page, then just to show you the performances on a risk return chart, and I've used the 10-year, but if you look since inception, all these funds have exceptional performance, better than average, better than peers as well. But I thought the 10-year would be more relevant because it shows the more recent characteristics and why we look at these funds. And with the active asset allocation that 91 managed, it's delivered an outperformance, but at lower standard deviation. That's just the volatility. 91 opportunity also, with their quality focus, has also exhibited those characteristics of lower volatility, but also better than average returns. Alan Gray and Coronation also being different, having a valuation approach, has delivered better than average returns, but it's slightly higher volatility. So, I mean, this just shows how the different characteristics or different styles that the fund managers have in selecting their shares and selecting their fixed income instruments and building their portfolios result in slightly different performance cycles. But over time, we're looking for fund managers that will do well over a long period of time. So you also get I mean, this is something that you have to expect, that for each one of these funds, you will get to stages when they are actually underperforming and also stages where they outperform. So they do go through different cycles of either outperformance or underperformance, which is why we recommend blending these different styles for clients in order to build more consistent return profiles over time. If we go on to the next section, then we're going to look at the boutique managers, where we've included the ABEX Balanced Fund and the Fairtree Balanced Fund. If you look at the fund sizes, quite decently sized funds at 4 billion and 3 billion respectively, but obviously much smaller than what you saw for those for the larger managers. But if we look at the equity style, then quite a decent valuation driven approach. So also looking at individual shares from a bottom-up fundamental analysis point of view, so actually going and analyzing different shares within the market, understanding them very well, but also having quite a big emphasis on how those assets are valued within the market. What's quite interesting is the Fairtree. Fairtree has a in addition to that bottom-up fundamental analysis, where they're looking at the shares, they also have a top-down macro view, which is potentially one of the reasons why they understand the resources market very well, but because they do quite a lot of in-depth analysis on the macroeconomic situation globally, and they do not stick to any one style, but actually flexible, so style agnostic, so they can be growth, they can be value. It just depends on where the best opportunities in the market are. And if we look at the performances of this respective on a risk return chart, and this is since a common inception, the Fairtree Balanced Fund, whilst we've known Fairtree within either the Fairtree Equity Fund or Fairtree Flexible Income Fund or BCI Income Plus, we've known them for a very long period of time. The Fairtree Balanced Fund is still fairly new, since 2017, but we're quite happy with the process that they followed there. And as you can see on this risk return chart, both ABAX and Fairtree have been able to deliver better than average returns, or actually exceptional returns in comparison to what the peers have delivered. But obviously, as you can see on this chart, with slightly higher standard deviation or slightly higher volatility. What you want there is a fund manager that can deliver good risk-adjusted returns. So if they're taking on a little bit more risk, or if the volatility is slightly higher, then what you would want to see there is the returns that are compensating for that additional volatility. If we just move on to the last section of if just looking specifically at the managers on the low cost side, where we've got the Net Group core funds and the Prescient Balanced Fund. So the Net Group is much more simplistic, using passive building blocks there. And then Prescient obviously has a more sophisticated thematic system that if you look at the equity style, they're using enhanced indexation, which is what we call portable alpha. So a little bit more sophisticated, but using the best of active and passive there. The Net Group core diversified, which is right there in the middle. If I just focus on that, quite a big fund, 20 billion in asset side. Asset size has been there since 2009, so has built quite a long-term track record and has done exceptionally well relative to the peers. So quite a good fund. The Net Group core accelerated is a much more aggressive fund when you look at that high equity category. So it's got a lot more growth assets in comparison to the other assets. We just recommend. It's still a fairly new fund, but if you're looking to lower the cost, or let's say add a lot more growth assets in a blend of funds, then you can look at that Net Group core accelerated, which is more aggressive but also comes in at a lower cost. If we just look at the performances of the Net Group and the Prescient, just on a risk return basis, then better than average return since that common inception, better than average, slightly higher volatility than your average peer, but still quite decent returns. So as you can see from when we started with the multi managers, looking at the large managers and boutiques and the low cost, all delivering better than average returns. If we just now look at the blends that we recommend obviously, like I explained earlier, you get different cycles. All the different managers can either outperform and underperform at different periods, just depended on what the market options are, or what the macroeconomic situation is. So we recommend different options, just dependent on what the requirements of investor may be. Let's say within this high equity category, you can have funds that deliver good returns but have lower volatility, like I showed with that 91 opportunity and 91 managed. So if you want to manage that volatility within that high equity category, then you can look at a defensive option within that high equity category, which is that option one on the defensive blend. Option two is just a lot more diverse, so not necessarily focusing on the higher returns or on defensiveness, but quite a diverse quite a diverse blend of different funds. And then also the third option, if you're if the client is a lot more cost conscious, then you can allocate a lot more to those lower cost funds, like your present balanced, your net group investment co-diversified. I mean, if you even wanted to add more growth, then you could even add net group co-accelerated, like I explained in the previous slide. And if we just look at the performances of these different blends that we've given, then since inception since the common inception, all these different blends have delivered a better than average returns. And as you can see by that black square, which is the defensive, slightly lower volatility, so you've decreased the volatility by allocating to a lot more to the lower volatile funds. The aggressive option and the low cost option have actually delivered pretty much the same return with the same risk profile. But obviously, it just depends on what a client, if they're more cost conscious, then you would want to allocate a lot more to the lower cost. If you just want to capture a lot more returns, I think over time, then you would expect that aggressive option to be delivering better returns over time. If we just move on to the last chart, which is performance again, just to show that what we're trying to build is portfolios that have consistent performances over time. So if we just look at a rolling 5-year basis, if you blend these funds, then you get a more consistent return profile over time. So this is these three different blends that we've built for you, and just comparing with peers and the average of the peers, that over time the blends, or this is historical, obviously, the blends have outperformed the average of the peer and pretty much been in that top or second quarter over those different periods. So this is what we're trying to achieve from blending funds together, a consistent performance over time. And yeah, I suppose that's it. Just if you look at that high equity category, Adrian, I'm not sure if we're going to go through questions now or at the end.
There's one from Kobe T that I think we can just touch on quickly. He's saying the trend is seemingly to move away from large equity and balance managers due to cost and perceived lack of flexibility, moving more to the boutique style managers. Is this increasing the case as with DFMs? And he wants to know what is our views around that.
I think there's a place for both the large managers and the boutiques. I think if it was as obvious, then over time you would only have. I'll give Alan Gray as an example. If you look at performance over the long term and short term performance, Alan Gray is the biggest fund that we've given there. They're currently one of the top performers. So that's a case for a large manager. But then they will still go through a cycle when they also do underperform. If you look at the boutique managers that have built a relatively longer term track record, like an Apex Balanced as an example, they've delivered consistent performance. The boutique managers definitely have a lot more flexibility in their ability to move their assets, but also for some of the larger managers, they've been able to show that they've got skill to deliver performance or outperformance over a long period of time. So it does take quite a lot of work into choosing the funds. There is a place for both. What just basically makes the most sense is to be able to blend those funds together. So have a bit of the large managers that have consistently shown skill over time, and have a bit of the boutique managers that have been able to show flexibility, and that they can use that flexibility well to deliver outperformance as well. And that blending those different strategies together may hopefully give you a consistent performance, which is something that you can see in these blending option charts that I've given you there.
Thank you, team. And could we just, I've shared with the Hampshire team some of it. So we got a very nice report from NMG, which they've done around sort of the main pain points and trends in IFA space. And most definitely the trend in IFA space is towards DFMs. And it is highlighted as sort of their most immediate investment need is to have assistance in selecting which funds to include in their portfolio. And again, within the group, we've got the various toolboxes that you guys can use, as well as Hampshire. You've got the seed shortlist, which is you can literally build any portfolio, local or offshore, using a combination of the funds on a shortlist. You've obviously got the Liberty solutions, the DFM solutions. So a lot already available to match and play with, which just take that onus away from you guys as the advisors. If you're building a balanced solution for a client for his RA savings, you don't have to go and analyze 228 balanced funds. You can go to the shortlist, look at the 8 funds that are there in that section, and work on a combination that works, or do the barbell approach as we've shown also as an example on the shortlist. Cool, guys. I'm going to hand over to Mike. Did you give us some insights around the seed balance fund? Thanks, Mike.
Thanks, guys. Yeah, so Tawanda's obviously run through a bit on the balance fund already as part of the multi-asset high equity shortlist category. But just to remind you, in the seed balance fund is an ideal fund for investors saving for retirement. It's Reg 28 compliant. We can invest up to the Reg 28 limits. Investors into the fund should have a time horizon of 5 years plus. We aim to protect capital over rolling 3-year periods, which has been achieved over 99% of the time. And over the long term, we wanted to try and generate returns of inflation plus 6. It's been quite tough over the last few years given weak sort of markets, but it's still a target that we sort of aim to achieve over the long term. We can probably skip the performance slide given that Tawanda's run through, and move on to the next slide. Essentially, seed balances, we're blending a bunch of building blocks and balance managers within one portfolio. Just less than a third of the assets are allocated to multi-asset or balance managers, and just over 2/3 currently are invested into single asset class or building block strategies. For most of the history, the majority of the funds were invested into building blocks, where we determine the fund's asset allocation using a strategic asset allocation or SAA, and then tactically adjusting the asset allocation based on market expectations, also known as tactical asset allocation. But as the fund's grown in size, it's allowed us to introduce more multi-asset strategies without increasing the TER of the fund. What we see is that multi-asset mandates are typically more expensive than their building block counterparts, as the manager is responsible both for the asset allocation and security selection in a multi-asset strategy. With the increased fund size of the seed balance fund, as Tawana mentioned, now at 1.3 billion, we've been able to negotiate better fees with the multi-asset managers and bring them in without impacting overall TER. The multi-asset component ensures that the fund's asset allocation is a composite of both our views and other multi-asset managers that we rate highly. And by combining the two, we should result in the fund delivering more consistent returns than in the past, when seeds views, asset class views are the only views expressed in the fund. I think key for us is that when investing into the seed balance fund, you're getting something different. On top of the manager selection implemented across the entire fund, you get our tactical asset allocation from seed, coupled with the multi-asset process of 3 highly competent managers. The blending of building blocks and multi-asset strategies within one fund as a key differentiator for the seed balance fund. So essentially, to a certain extent, we sort of managing a bit of a short list within the fund. And you'll see some of the names coming up in the next slide are some of the names you may be familiar with and have seen on the shortlist. So if we move across now, we've got on the multi-asset side within the seed balance fund, we have a 10% allocation to each of ABAX, Prescient, and Visio. So we included the Prescient balance fund into the seed balance fund just over a year ago. This fund is a low-cost balance fund. It makes use of Prescient's fixed income and derivative capabilities to generate peer-beating returns. It will make minor tactical changes to its asset allocation in extreme cases, and has 45% invested globally, with a large chunk of this global exposure hedged back into rands, and Prescient balance obviously sitting on the shortlist. With the success of the allocation to Prescient balance in our balance fund, towards the end of last year, we looked to increase allocation to multi-asset strategies. We've had a mandate with Visio in the seed balance funds since the beginning of 2012, so in excess of 10 years. They've done very well over this period, and for most of the period, the mandate was a flexible equity mandate. So we wanted them to outperform equities, which they did, but with the ability to reduce their exposure to equities. Over time, we've widened the ability for them to use other asset classes, but still maintained an equity benchmark. And then towards the end of last year, given that they've grown their team substantially and have a highly credible multi-asset process, we took the opportunity to convert our mandate from an equity-centric one to a multi-asset mandate seeking to outperform peers. They do have a small Visio balance fund that's been managed, or that's been going for just over 3 years now, and is a top performer. And since we've shifted our mandate to a multi-asset mandate, they've continued to do very well. And then finally, on the multi-asset side, in the stable fund, we've been invested into a multi-asset strategy managed by ABAX since early 2016, so for over 7 years. Over this time, we've got to know them a lot better, and been very impressed with their process and multi-asset capabilities. After looking at a range of multi-asset strategies, we decided at the end of 2022 to include the ABAX balance fund into the seed balance fund. So again, ABAX balance fund is a newer fund into our shortlist. ABAX, as Tawanda mentioned, have expertise across all asset classes and an asset allocation. Furthermore, they have strong ability in derivative strategies. These are all combined to generate asymmetric payoff profiles, i.e., they aim to achieve more upside than downside. The ABAX balance fund is typically only available to institutional investors, so it's not on many of the platforms and not generally easy for advisors to access. So including in the seed balance fund does add an extra dimension for us. When we look at the balance of the fund, it's invested into single asset class strategies where we determine the weight for each asset class and each manager. We have a rigorous process to overweight asset classes offering the best expected risk-adjusted returns, and underweight those offering the worst expected returns. At the moment, relative to our SAA, we are slightly overweight local equity and quite a bit overweight local bonds and global notes. And then we have underweight positions in global equity, cash, bonds, and property. We can see a big component of this portfolio is the Fairtree equity mandate. Has been part of the fund for just over 7 years. In this period, it's outperformed the market by nearly 7.5% per annum. So exceptional returns, and sort of pretty much top of the pile. And despite some recent changes to the team, we retain a high degree of confidence in them, and hence have allocated the full local equity allocation to them. We don't want to dilute them in the local equity space. The bond allocation is split between Ned Group, which is managed by Quanta and Seed. Ned Group has a peer cognizant process and aims to generate consistent outperformance at a relatively low cost. The Seed component allows us to directly allocate to bonds when opportunities arise, and lock in rates when they're attractive. As a way of example, last week in the height of the sell-off, we were able to pick up the R2037, which is a 14-year government bond at a yield to maturity of 12.5%. This is 8% above the Reserve Bank's inflation midpoint, and would expect to generate equity-like returns from this investment. For an asset class that carries a lot of risk, it's not quite a no-brainer, but it makes a lot of sense. And by investing directly, we're able to exactly get the yields and those assets that we want within the portfolio. Global notes are another differentiator for Seed. They allowed us to generate global equity-like returns with a degree of capital protection. Then the global equity exposure is gained through the Seed Global Equity Fund. It's a blend of active managers that have proven long-term track records, passive building blocks that allow us to gain access to the market, and offer us this access in an efficient and low-cost manner. So a combination within the Global Equity Fund, which in itself is managed actively. And then finally, just to sum up and I guess position the Balance Fund versus the other shortlisted funds. On this chart, I've shown the Seed Balance asset allocation versus the shortlisted peers, the average, and then the highs and lows. I've taken out the Nedgroup Core Accelerated. It is that very aggressive fund that has 90% invested into equity and property. So it does skew the numbers slightly, and it is a very unique fund. But as you can see from this chart, the asset allocation is broadly in line with the peer average. There are some differences. Our exposure to local bonds is higher than average and higher than any of the other shortlisted funds. As I previously mentioned, we expect equity-like returns from this asset class. So on a risk-adjusted basis, we favor them over all asset classes. Our allocation to global equity is lower than average and closer to the minimum of the shortlisted peers. We expect that there will be a recession in the US before the end of the year. With it, there will be potentially some market weakness. Given the weakness in returns and the drawdowns in 2022, we don't expect another major drawdown, but global equities could come under a bit of pressure, and this underweight keeps some powder dry in case of this eventuality. Finally, you can see our total global exposure is slightly lower than average, given the attractiveness of local asset classes versus global asset classes. And given the fact that the rand is very oversold, we do expect that local assets will, at least on a relative basis, outperform their global counterparts. Over time, we do expect that our allocation to global assets will converge with our peers. And it's interesting to note that we're sitting just over a year after the increase into 45% in the offshore limits on Reg 28. The average global allocation of the shortlisted funds is now close to 40%. So that has been gradually creeping up over the past 12 months and is something that we continue to monitor. I think looking at this asset allocation, in aggregate, our fund is probably slightly more conservatively positioned than our peers. Given the tight monetary conditions globally, putting a brake on developed market economies, we feel it's prudent to be a bit more conservatively positioned. But obviously, the Balance Fund is actively managed, and where the markets shift and where opportunities change, we will continue to manage and change that asset allocation. I think that's always an excellent selling point for balanced or multi-asset high equity funds, is that the managers are actively managing them, in most cases changing the asset allocation as opportunities arise, compared to advisors making use purely of the building blocks, where the shifting between asset classes or the responsibility for that then falls on their shoulders. Thanks. So that's the end. I don't know if there's any questions on the Balance Fund. Otherwise, I think we've hit our limit.
Guys, are there any other questions for Ian, T-Man, or Mike? We're very close to 10 o'clock, but probably time for a quick question if there is one. There's none. We want to thank you for your attendance and look forward to seeing you again next month.